Hi, and welcome back to Investment Banking University. This is our investment banking course, and we are to the third side of the perpetuity, the buy side. And the buy side, the key question there is how to buy a perpetuity. And of course, we're dealing with the buying of perpetuities by private equity groups and corporate M&A departments within corporations. So for those that have already built perpetuities, and their representation, there's another category known as the buy side. The buy side is made up of financial buyers, private equity groups, and strategic buyers, corporations. So in terms of the buy side, like we just noted, the key question there is how to buy a perpetuity. So we're going to answer that question in the context of the principle of investing. The principle of investing is to only invest in perpetuities or risk-free assets. The key is to determine whether the company or opportunity is a perpetuity or not. We're going to employ financial statement modeling and valuation to make this determination, as well as perpetuity analysis. So financial statement modeling begins with the building of an operating model for the company. And after determining whether the company or opportunity is a perpetuity, strategic and financial buyers attempt to maximize the difference between NPV, which is net present value as measured by a DCF, discounted cash flow model, of the company or opportunity, and the contributed capital to acquire the opportunity. So we're trying to maximize the difference there. The difference between these two is in fact the real wealth transfer from the seller to the buyer in today's dollars. For example, if the NPV or intrinsic value of a company is 100 million based upon a DCF, and the acquirer actually purchases the asset for 75 million, the acquirer has received a transfer of wealth from the seller to the buyer in the amount of 25 million in today's dollars. This is the game of buying perpetuities. So we're looking at the following formula, which is the wealth increase in today's dollars from a company or opportunity, and we're calling this margin of safety, and we'll talk a little bit about margin of safety as it relates to Warren Buffett's philosophy. So this margin of safety is known as the difference between DCF NPV and contributed capital. One can further maximize their returns by employing leverage in the form of other people's money. Ideally, the financial or strategic buyer would continue to make such acquisitions using separate entities, SPVs, allowing them financing for each, as well as public equity and LP capital where available. So this is just an infographic depicting what we just talked about, and the answer to how to buy a perpetuity is discussed in another question, how to be an investor. And so this is just talking about the margin of safety formula in terms of the wealth increase in today's dollars from a company or opportunity is the difference between the DCF, NPV, and contributed capital. So how do we take the principle of investing and use it to become the next great investor like a Warren Buffett? So how do we become the next Warren Buffett? Well, in order to become the next Warren Buffett, we need to understand the nature of the perpetuity, which is the basis for finance, and his approach. So finance is, of course, the set of concepts, methodologies, and optimization models associated with the perpetuity. And the perpetuity can be modeled as we talked about before. So really it comes down to knowing perpetuity science and then utilizing the principle of investing in a portfolio context, meaning building a portfolio of perpetuities like Warren Buffett has done. So taking one perpetuity and using that to buy another perpetuity and using that, and then this approach of stacking perpetuities allows for his philosophy related to compounding of returns as well. So the principle of investing and Warren Buffett's approach is to only invest in perpetuities or in risk-free assets. And the key here is to determine whether the company or opportunity is a perpetuity or not. And so we talked about how to do that. And Warren Buffett often speaks of a margin of safety, and this is the maximization of the difference between net present values measured by a DCF and the contributed capital for the opportunity. So one of the things Warren Buffett also talks about is not necessarily seeing diversification for its own sake, but actually concentrating capital within perpetuities. So even if there are a lesser amount of perpetuities, concentrating capital in the perpetuity itself is going to lead to greater returns over time rather than diversification for its own sake. So it's sort of a paradigm shift in its approach in terms of diversification. So we are either going to purchase perpetuities or not invest, or just in risk-free assets, for example. The larger the perpetuity, the better, and characteristics of a perpetuity include low capex, capital expenditures as a percentage of EBITDA, predictable if not recurring revenue model, and low levels of customer concentration and low dependence on the owners to exist. In terms of capital, you're going to want to have an evergreen source of capital, which means that there are no required timeline of the return of capital. This is different than the traditional private equity where LPs expect a return of their original contributions in approximately 7 years. This forces GPs to sell their portfolio companies in approximately 5 years from acquisition. Taking the evergreen or Buffett approach allows one to accumulate wealth associated with the cash flows and the terminal value of a DCF, and to use the aggregate cash flows to purchase additional perpetuities. This is what built Berkshire Hathaway, and the compounding of returns that happen in those later time periods leads to the exponential increase in wealth that's associated with the success of Warren Buffett and Berkshire Hathaway. So ultimately, you're going to want to either build a perpetuity yourself or start a private equity search fund if you're just getting into private equity, and acquire a small perpetuity and then scale up from there into larger perpetuities. And using one perpetuity to purchase additional perpetuities is what made Warren Buffett what he is today. And so now we're going to talk about the operating model. And we're actually going to use talk about the operating model in the context of cases. So we're just going to discuss it at a high level and then get into it later on in the course in the cases. So in terms of the operating model, we're going to start with an operating model previously built with an integrated financial statement model. From here, we're going to build on a transaction, for example, an LBO if you're a financial buyer, a merger if you're a strategic buyer, or if you're looking at it from a capital markets perspective in an investment bank, an ECM or DCM, equity capital markets or debt capital markets. We can utilize that as well. If we're a financial buyer, talking about private equity and doing LBO, we're going to be building an LBO off of the operating model. So there are over 4,000 financial buyers in the world. They command over $2 trillion in capital and are broken down in the following categories: leverage, buyout, growth, and mezzanine. And there are actually other types like venture capital, etc. And we're going to get into that as well later on in the course. But for now, we're just going to focus on those main ones as it relates to the buying in perpetuity. So while each of these private equity firms have different hurdle rates, each perform an LBO analysis to determine whether or not to purchase a perpetuity. And there are two types of private equity plays: the platform, which is a standalone company that is the basis for a strategy, including consolidation, or an add-on, which is an additional company acquired that is quote-unquote bolted onto an existing platform. Private equity firms have 7 to 8 years to invest and get returns and be done with the fund. They have a 2% management fee generally, and they are targeting about 20 to 25%, and think in terms of spread over treasuries. IRR is the name of the game, in which the main drivers of returns being acquisition price, the amount of debt raised, and future operating performance of the organization that they're purchasing or target, which are model projections as well. There is an aspect of buying low and selling high regarding multiples, for example, an 11 times entry and a 13 times exit. And you can use the following as a general rule for a private equity group. If there's a 15% IRR, don't do the deal. 20% IRR, you're going to most likely think about doing the deal. And 25% IRR, you definitely have to do the deal. So regarding ideal private equity targets, the private equity firm will specialize in a few sectors and does not want to have a lot of discretionary CapEx. They will, however, do maintenance CapEx, and they will look to rework accounts receivable or accounts payable contracts in order to increase the value of the target. Furthermore, after an acquisition, the private equity group to look to pay down debt as fast as possible, and they ideally want to do dividend recaps or recapitalizations and to add additional cash and then pay itself a dividend after paying additional debt. So the private equity firm, when considering an investment, will run multiple cases to determine what case to build on, and they will do sensitivity tables as well. The private equity group will work with LevFin in the investment bank, SLF, and DCM. in terms of leverage finance, syndicated leverage finance, within a given investment bank, with SLF doing or syndicating the loans and then selling the paper. The investment bank charges a financing fee, advisory fee, and a syndication fee. So in terms of a leverage buyout analysis, we're going to locate the financial information, build the operating model, input the transaction structure, complete the LBO model with the new structure, and run the LBO analysis to determine what returns we're ultimately going to have. So banks want to see about 20% to 30% of equity contribution for a financial sponsor. And this depends on the industry. So 50% is usually necessary for a technology company. And banks look at leverage ratios and interest coverage to determine which covenants to put in place. So in terms of actually modeling the LBO, we're going to integrate the pro forma balance sheet into the operating model, which shows the change in the level of debt and intangibles. And then we're going to have the income statement, the balance sheet, and statement of cash flow projections integration. And then we're going to run the IRR analysis for the financial sponsor. And then if there's going to be a hybrid debt lender like mezzanine, we're going to have to find out what the EBITDA is and how much is cash and how much is debt. In terms of going forward from there, we're going to do sensitivity tables, we're going to have credit ratios, and we're going to look at these different aspects in the cases that we run. And just in terms of notes that we're going through right now, PIK, payment in kind, allows you to get more leverage, so we're going to factor that into our models as well. So an LBO model is pretty much an M&A model and a DCM M&A transaction and a DCM transaction in one. And so the EBITDA multiple is going to be determined from the midpoint of the football field that we calculate in our valuation, as we discussed in the past. And then in terms of transaction fees that occur, we're going to have financing fees for SLF and DCM, and then investment banking fees for M&A, legal fees for the lawyer, and other fees. And in terms of leverage, it's going to be spoken in terms of times leverage, which means times EBITDA. And so that's what you're going to hear in investment banking. SLF and DCM go through cases of an operating model to find the optimal tranche of debt to provide the highest leverage to the financial sponsor, but can still be sold in the marketplace, meaning selling the paper. Pro forma means as is after the transactions in terms of adjustments or changes, and then pro forma is after the changes. So in terms of the operating model, we're going to start with the base case without the transaction. There's going to be a sponsor upside case, a sponsor downside case, and then each case underneath a line item in the assumptions tab that we build into our model. And we're going to be factoring in a choose function to then choose the different case, which shows which populates throughout the model. In terms of the key question, we're going to ask the question, is the capital structure correct to allow you to pay down amortized debt and other tranches of debt? And we're going to look at net cash flow being generated and then determine if unsecured needs to be PIK, payment in kind. If there's not enough cash flow, then we need to have PIK. And ultimately, we're going to talk to the credit officer to get the capital structure that is optimal. And we need to do accounting quality of earnings analysis to get to true EBITDA. Oftentimes in the M&A process, we're going to have to verify that EBITDA. So financial sponsors want to see a sensitivity table with highlighted options that make sense and sensitize the entry multiple and exit multiple for IRR. Looking at the credit officer meeting that we have to go through in order to obtain the bank financing, it's oftentimes going to be a 25 to 30 page, 5-page deck. It's going to talk about the industry, the sponsor thesis, and then a 1-page summary of relevant financial statistics, one for each capital structure. So the question that the credit officer is asking is, how quickly does this company get delevered through time? And then in terms of the private equity work, in terms of our private equity group, we're going to review 10, 20, 30 SIMs, confidential information memorandums for an opportunity or target per month. So in terms of a private equity interview, for those that are trying to get into an existing private equity group, the interview is number one is going to be based on experience, and then the interview two is going to be saying you have 2 hours to build an LBO model and tell me whether or not to invest. And that's going to be the basis for that interview. So it's actually going to be a case. So that's it for this video. In the next video, we're going to get into being a strategic buyer, meaning a corporation, and a merger model associated with that.